Because oil crossed $95 a barrel Thursday, up more than 40% since the U.S.-Israeli war on Iran began, equity markets repriced what the conflict actually costs in inflation terms. The S&P 500 fell 1.5%, but the Nasdaq's 2.1% drop into correction territory told the more important story. The sectors most exposed to rising real rates bore the heaviest load. The mechanism was straightforward. Brent crude clearing $109 internationally forced the OECD to revise its G20 inflation forecast upward from 2.8% to 4% for 2026, and bond markets responded immediately. The 10-year Treasury yield climbed above 4.4%, with 30-year bonds approaching 5%. That repricing cascades into every consumer lending rate in the country. Trump told his cabinet that energy prices had not gone up as much as I thought, while simultaneously acknowledging the military campaign is not over. Analysts see no near-term resolution. Goldman Sachs projects Brent averaging $105 in March and spiking to $115 in April before any retreat, with an adverse scenario reaching $140 if the Strait of Hormuz remains severely disrupted beyond 6 weeks. If that adverse scenario materializes, the stock market's inflation calculus resets again from a higher base. The same 10-year yield that hammered equities is the direct transmission mechanism from the battlefield to the American housing market. Mortgage rates track the 10-year Treasury almost tick for tick, and the 30-year fixed rate rose to 6.38% this week, its fourth consecutive weekly increase and the largest single-week jump since April 2025, when Trump's tariff announcement rattled bond markets. The timing is brutal. Just 1 month ago, rates had briefly dipped below 6% for the first time in more than 3 years, a threshold economists believed could finally unlock the supply-constrained housing market after transactions fell to 30-year lows in 2025. That window closed as quickly as it opened. On a $450,000 home with a 20% down payment, a buyer locking in a rate today pays over $33,000 more over the life of the loan than someone who locked in 4 weeks ago. Redfin data shows 630,000 more sellers than buyers, the widest gap in at least a decade, meaning supply is finally there, but affordability has slipped away again. If the 10-year yield stabilizes below 4.3%, mortgage rates could retrace towards 6%, which Coldwell Banker CEO describes as the threshold where healthy demand returns to the spring selling season. If yields hold above 4.4%, the spring recovery stalls entirely. The oil shock's damage to jobs is not distributed evenly, and Goldman Sachs has mapped the mechanism with unusual precision. The bank estimates the current oil price environment will suppress U.S. payroll growth by roughly 10,000 jobs per month through year-end, but the cut falls almost entirely on leisure and hospitality, which accounts for 5,000 of those monthly losses, with retail trade shedding another 2,000. The logic is structural. Energy price surges compress discretionary consumer spending first, because households continue paying for essentials like healthcare and housing while cutting restaurants, hotels, and shopping. Goldman's own commodities team flags that even the energy sector won't offset these losses, because productivity gains in shale extraction mean production can rise without adding workers. The 1970s parallel holds imperfectly. Goldman estimates oil price shocks now carry roughly 1/3 the unemployment impact they did between 1975 and 1999, because the U.S. economy is less oil-intensive and domestic shale provides a partial cushion. Gen Z bears a disproportionate share of this friction. B of A data shows Gen Z carries the highest ratio of gasoline spending to discretionary income of any generation, and many work in the exact leisure and hospitality jobs Goldman projects will shed the most hours. If Brent retreats towards $80 in Q4, as Goldman's base case assumes, the labor drag reverses before it becomes structural. If the conflict deepens and crude holds above $115, the leisure and hospitality losses accelerate into a demand destruction cycle. A Los Angeles jury's March 25th ruling against Meta and YouTube introduced a new cost variable into big tech's balance sheet, one that has nothing to do with AI competition and everything to do with platform design liability. The jury found both companies negligent in the design of their platforms and awarded a combined $6 million to a plaintiff who testified that Instagram, Facebook, and YouTube's autoplay and infinite scroll features kept her online up to 16 hours a day, fueling depression, body dysmorphia, and self-harm. The significance is not the $6 million, it's the precedent. Both companies face thousands of similar lawsuits, and this bellwether verdict validates tech addiction as a cognizable legal theory. Meta's stock has already been under pressure from separate AI competition concerns, and the legal liability now compounds the valuation uncertainty. The mechanism connecting this to broader markets is insurance pricing. As platform design liability becomes quantifiable, the cost of operating engagement-maximizing algorithms rises, which pressures the business model that drives Meta's $1.4 trillion in market cap. Meta said it respectfully disagrees with the verdict and is evaluating options. Google plans to appeal. If courts in subsequent cases expand damages materially beyond $6 million, the economic case for infinite scroll erodes faster than any regulatory intervention could force. While the Iran war dominates headlines, a slower-moving credit crisis is reshaping the financial baseline for an entire generation. FICO data released this week shows the national average credit score fell to 714 in the second half of 2025, its lowest since early 2020, but the generational split is what matters. Among Americans aged 18 to 29, 14.4% saw their scores drop by 50 or more points between 2024 and 2025, versus just 10% of the broader population. The mechanism is student loan resumation. The Trump administration's aggressive restart of collections, combined with a court ruling against Biden's income-based repayment program, has pushed 7.7 million borrowers into default on $181 billion in federal loans. More than 7 million borrowers reported a new credit delinquency last year, triggering an average 62-point drop, enough to push many from prime to subprime borrowing status. A 62-point decline doesn't just affect credit card rates, it closes the door to favorable mortgages, shapes job screening decisions, and compounds the oil-driven income squeeze already hitting Gen Z in leisure and hospitality work. If the courts ultimately reinstate income-based repayment protections, delinquency rates could stabilize. If the current enforcement regime holds, the credit quality deterioration among under 30 borrowers sets a floor on consumer spending recovery that even a peace deal in Iran cannot quickly lift. 3 mechanisms now compete to determine where markets go from here. First, the Strait of Hormuz. Goldman's base case assumes severe disruption for roughly 6 weeks, with Brent retreating towards $80 in Q4, but any extension of the conflict resets that timeline and puts $140 oil back in play, with compounding consequences for inflation, rates, and jobs. Second, the Federal Reserve's dilemma. Rising oil prices are inflationary, but falling jobs and collapsing consumer credit are deflationary. If both forces intensify simultaneously, the Fed faces the same policy paralysis that defined the 1970 stagflation trap. Third, big tech's legal exposure. If Meta's and YouTube's stock prices begin pricing in systematic platform design liability, the AI infrastructure spending boom, where Meta alone is committing hundreds of billions through projects like its Hyperion data center in Louisiana, faces a tension between capital deployment and mounting legal costs. Each of these watch points has a conditional inflection. Oil below $85 relieves mortgage and jobs pressure simultaneously. A Fed rate cut signal to 4Q2 would reopen housing demand, and Meta winning its appeal would cap the legal liability expansion. Until at least one of these resolves, the market's path remains a function of war duration, not earnings.